I'm Gary Venner, Managing Director of IFA Acquisitions, and I'm joined by Marais, Director of Vertus Capital, where we continue our informative question and answer series on our YouTube channel to provide insights into the funding processes when buying an IFA business. The title of the next video is coming up on screen now. So Matt, for businesses that are looking to grow and requiring finance to enable them to do so, what is the process of them obtaining this finance?
So there are a number of stages at which IFAs could engage with us. What we find is the most helpful is almost at the stage where they're planning an acquisition journey. So it could be a single acquisition, it could be multiple, but they're kind of honing in on what they would like to do in their growth strategy. Why it's helpful to talk to them at that early stage is because we can give them a sense of how fundable that plan is and roughly how much capital they could get if it's a multi-acquisition. We can give them some rules of thumb as to how we would think about underwriting, obviously all subject to underwriting and due diligence, but we can give them some steer on what to expect in the balance of the process. So we find that's really helpful. But quite often we'll engage with the client who comes to us with a specific acquisition. So they're not just planning, they actually have identified a target, they have numbers, and they'd like to proceed. That's obviously the most tangible time to engage with us, because at that stage we can actually give them a term sheet, we can do some underwriting, and we can give them some comfort that they can carry on with their discussions. What we do find, and one thing I would say to firms looking at a growth strategy, is if you would like to borrow some money, start the process early, because you don't want to build into a deal you're doing an inherent flaw that disrupts the finance. You want to kind of co-create the two alongside each other. So we find it quite helpful to firms that come and speak to us early on in the journey, and we find they get some value from it. Obviously we can't advise on their deal, but we do find that they glean some useful insights into how to do deals, because we have seen a few of these deals in the market.
Yeah, and I understand it's a chicken and egg really, isn't it, about getting the target firm first, or do you get the finance? But clearly, you know, it's what you don't know, and that's about the availability of that finance. So I guess it's always, I would suggest, let's get them involved talking with you at an early stage.
Absolutely, and that's where the rules of thumb become quite helpful, because if I was going into an acquisition, I would want to know, firstly, is this capital going to be provided or likely to be provided? And secondly, what quantum would I be eligible for? And so we've obviously practiced getting potential clients to a point where quite quickly they can see how much they can or can't borrow and how the terms would look. We can outline the terms, we can speak to what the security and the structure would likely look like, so they have some certainty going to the next stage. And we also find in their discussions with potential targets, it comes up quite early in the conversation, and it's helpful for them if they don't need to say funding secured, but they could say, we've had some initial discussions, we know that we're likely to be eligible for this, and to give the target some comfort that the capital will likely be provided.
And we know that this is an area where we're talking to many acquirers that are looking to grow and want to know about their funding options available, is that we can actually get them introduced to you at that point, and you know, give them more sort of understanding of the size of the acquisitions that they can now look at.
Absolutely, and we do find the sector's quite specialised. So it's not that easy to provide someone with a one-pager that answers all their questions. There is a conversational and relational element that's required in these deals. So it's very helpful for us to be able to get 15-20 minutes with a firm that's looking at acquisition, just to give them a bit of a sense of how things work, answer their specific questions. We find that more helpful than if we were to try and put out a deal guide that laid it all out,
Sure.
Because there's no two deals that are exactly the same.
Yeah, and for some firms, they are possibly able to find the finance themselves, or, you know, within their own funding and their own sort of cash balances to be able to do it. But leveraging finance can actually just take that pressure away from them as well.
Absolutely, and for firms that do have their own capital, sometimes it's helpful just to get a third-party look, or just to get a sense of, well, what else is available, how could that look, or before I do an equity capital raise, how would the debt look? We find that gives them a bit of a a bit of comfort going into what ultimately they will do in their capital raise, whether it be debt, equity, whether it's high street equity or equity or debt with a specialist provider like us.
How competitively priced is Vertus compared to other funding providers for acquisition purchases?
So Gary, it's hard to compare us to other providers in the market because there aren't any other specialist providers. What we do see is there's a spectrum of capital that can be raised and that comes at a different cost. So on the one end, raising private equity capital, very expensive because ultimately you're selling equity, and that's a very expensive way to raise capital, appropriate for some. On the other end, you've got the high street banks who would probably come in at the lowest cost of capital. The challenge there is that they're often not willing to lend as much. The terms aren't as bespoke to this sector, and we would sit somewhere in between. So I can tell you that you would come in single digits for sure. I can tell you that the facility would be the most bespoke to an IFA acquisition. The covenants would be appropriate to that kind of a deal. The amount to which we would be able to provide for an acquisition would likely be higher than a bank would provide. So you get what you pay for, and in our case, what you're getting is something that's bespoke and customized to deals of this nature.
I often find that either banks don't want to lend in this sector, or if they do, they're sort of wanting to have the full belt and braces on security, with personal guarantees supported by first or second charges over their personal properties. How does Vertus look at security for these type of deals?
So Gary, we find the banking world and security universe in the UK is set up very much to start with the individual. So they'll look at an individual's personal credibility, assets, balance sheet, and then work their way down to the next level of security, which would typically be the IFA business that they own, or the holding company or the group. And then finally, they would consider the target business as potentially something that's worth securing. But very often, the primary focus for them, and that's how the market for them is set up, which is lending across a broad spectrum of industries. It's not just IFA specific. So it'll be to start at the individual and move down the business and the target. What we've tried to do is understanding how the cash flows, the valuations, and seeing how compelling these businesses actually are as credit risks is to do the opposite. So we would try and start first at the target business, the borrower co, and finally, if required, we would look at security over the individuals. Now, what we won't ever do is specify assets, go through a detailed personal guarantee process and personal asset underwriting. Our focus would typically be, first, let's look at is the target appropriately valued? Secondly, can the borrower afford to acquire the target? And when you put those two together, do you get a picture that's suffice to repay the loan with obviously some margin for a rainy day? And then finally, if there's still some skin in the game that's required, either to ask the borrower to provide a deposit on the acquisition of some sort, or to say, well, in events where we can't find a deposit, possibly would you look at providing a limited, normally limited several personal guarantee that's limited to 25, 20, 30% on the loan, just to make sure that there's an incentive for the key individuals that we're operating with, that if a deal didn't go well, there's an incentive for them to stick around, make sure the thing works. Because really what we all know we're securing is an IFA's key relationships that they have with their clients and making sure that those continue beyond the acquisition.
And that makes perfect sense. And it's so refreshing again to hear that you do look at the target business that's being purchased, because, from my experience, I'm finding that sometimes the mainstream and the secondary banks are not looking at that target business. They tend to be wanting just to look at the standalone business as is today. So that's great to hear that you do it in reverse.
And it's allowed us to fund some deals that credit providers wouldn't look at, because we're able to see, well, what is this target business actually worth to the acquirer? If we see that actually this is a good commercial opportunity for the acquirer, it's very helpful for us to then say, well, over a 5 to 7 year cash forecast, we can see that this business is very likely, including the potential for some COVID-like or Ukraine war type shocks to take place. Despite that, there's still an opportunity here for this business to fund the loan stably over the coming 7 years.
So Matt, IFA acquisitions are normally in two parts: upfront payment plus deferred parts as well, whether that's over 1, 2, 3 years, etc. So how does Vertus help to fund the future payments as well as the upfront payment?
Good question, Gary. So we see the need, if you're going to enable IFA deals to happen, you have to have some kind of a facility element that deals with the deferred payments. So we see it in principle as a purchaser will have a series of commitments that they have to fund. They also have a target and their business that's generating cash that sometimes funds some of those commitments. We say to them, do your forecasting, bring us a picture of how much you'd like to borrow on the upfront and all the deferred payments, and we build a facility that bespokes to those amounts. So that's a long way of saying we will provide a facility that gives them the upfront component, and within some reason we don't fund beyond 8 years, but if there's a 1, 2 or even 3 year deferment period, they can come to us for security that that capital is available as and when those obligations become due 1, 2 or 3 years from now. Now that's really helpful because firstly, from a seller's perspective, they often ask the question, how do I know I'm going to get paid?
Yeah.
This answers that question. The buyer can say, we have a commercial facility that provides not only the first payment we're making, but some or all of the second, third and fourth payment. That's helpful for both parties. For them as well, sometimes they might have a picture that they can self-fund acquisition, deferred payments 2, 3 and 4. In reality, COVID hits, markets change, there might be a recession. There's a lot of factors that can change a perfectly healthy looking 5-year forecast. Knowing that there's capital secured for that second, third and fourth also means the business owner doesn't have to worry about the default risk on an acquisition or not being able to make a deferred payment to a seller. So we find that to be a helpful meeting of buyer and seller needs in providing finance that the buyer wants now but doesn't want to pay for now. Well, they don't. They'll pay to set up the facility, but they only pay for the deferred payments as and when they're required at the end of year 2, 3 and 4. So that we find is a helpful bespoke nature of what we do in these facilities.
And I think this works for both parties really, doesn't it? The acquirer and the seller here. It's that peace of mind knowing that there is backup for funding in the event of needing it. Sometimes it will definitely be required, and other times, from what you're saying, is it may or may not be needed, but at least there's an agreement which presumably could be shared with the seller to give them the peace of mind that everything is in place.
Absolutely, and in fact we've had some deals which the borrower didn't want to fund deferred acquisitions with us, but the seller wasn't comfortable to proceed until they knew that the borrower had funding secured. And so what that allows us to do is to say, well then let's tack on at least the first deferred acquisition onto the facility so that they know, all parties know, the funding is there. If there's surplus cash that's generated by the business in the period, that's the principal's money to take out as a dividend.
Matt, I think I know the answer to this already, but can IFAs use you to fund multiple acquisition deals?
So yes, Gary, they can. In fact, the way we look at it as a strategy is our desire is to be a capital partner to firms through a growth life cycle. So we would like to help firms do a series of acquisitions and acquisition, and ultimately to get to a point where we help them fund their own exit, so with the next buyer, or if it's an MBO, funding the staff to buy them out. But really we see this as a longer term funding partnership. The only difference is we're using debt to help on that journey rather than equity, which is very favourable to them because they don't need to sell all the shares to us in that process. So the short answer is yes, we will. We'll either fund deferred payments on an existing, or we'll fund a number of transactions, and a lot of our clients have come back to us for repeat business. It's much easier once you know a client, you've funded an acquisition in the past, to help with the next part of their growth journey.
Make sure that you subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in this series.